Welcome to the Commercial Real Estate Show. I'm Michael Bull, your host to the world of commercial real estate. We are your source for insightful analysis and enlightening discussions. Today we have a great show for you. We're going to talk about the multifamily market. You know, apartments have been very hot performance-wise and in the investment sales market. So we'll look at the performance, we'll look at cap rates, we'll look at some management tips, and talk about the apartment industry. Please welcome my first guest. Is Jay Parsons. He's Director of Analytics and Forecast with MPF Research, which is a division of RealPage. Jay, thanks for joining us today.
My pleasure. Thank you for having me.
Well, Jay, thank you. And I guess we all feel that 2014 was great for performance and rental rates and occupancy, but what was the real story? How did it end up?
Well, you know, Michael, I hate to sound like a shrill for the industry, but the numbers are just so good, it's hard to downplay that story. Really was an incredible year for the apartment industry. Going into this year, if you recall, a year ago, everyone was talking about all the supply was going to hit in the market, and so surely demand couldn't keep pace, rent growth was going to tick down, and the opposite occurred. We did complete a lot of units, 232,000 over the past year, the highest since 2000. But demand was incredibly strong, more than 250,000 units absorbed on net for the nation's core 100 metros. So as a result of all that, vacancy ticked down 30 basis points and comes in at 4.7% as of Q4. And again, very impressive story. And the rent numbers are even better. A year ago, it really looked like rent growth was leveling off around 3%, and a lot of investors were starting to say that the best days for NOI growth are in the rearview mirror and need to start looking at other sectors in commercial real estate for better upside. But rent growth really accelerated beyond even the most optimistic of expectations, 4.6% growth in new leases in 2014, and that nearly matches the peak that we saw earlier in this cycle back in 2011, and it's only the third time since 2001 that we got above 4.5.
You know, that's incredible, because if I had to put that kind of rental rate growth in my pro formas, the investors would have said, no way. Right?
Oh, yeah. They would have shot you down really quick.
And is that for Class A and B, that performance?
Yes, that's overall. Okay. And when you look at the different classes, B is certainly the standouts right now. But even the A's have done better than expected. I mean, given the amount of supply, you would have thought that rent growth would be leveling off in the A's, but that hasn't happened.
Okay. So what do you expect moving forward? What's the crystal ball look like?
Well, you know, it's pretty tough to look forward. I think there's a wide range of performance or possibilities in the performance. You can certainly make the case that we could sustain rent growth of 4% given the strong demand tailwinds that we see. You know, the real challenge in looking ahead is that we're really in some uncharted waters relative to the last 15 years. Now, you think back to the last few supply peaks that we had in the last 15 years, early 2000s, and then again 2008, 2009. Those supply peaks were met by recessions. And so really for the first time in more than 15 years, we have a lot of supply at the same time we are actually getting really good job growth. So, you know, we have to go back to the, you know, right around 2000 to really get a comparable period to look at. So our baseline view is kind of a moderate view. We think occupancy is going to tick down about 40 basis points just because of so much supply hitting next year. We'll have even more in 2015 we had 2014 will be the highest level since the late 1980s. But we think demand remains very strong, just probably not enough to keep up with supply. We've already burnt off a lot of that pent-up demand that we've seen for those new units. And rent growth we still see as a very good story, but certainly decelerating from the 2014 number. We're forecasting rent growth of 3.6%. But again, that's still a really good number relative to historical norms.
Right. Yeah, you can't lose sight that just because we had such a robust 2014 that 3.6 rate growth, that's credible. I mean, that's really strong. And so what about for the different classes? So what about A, B, and C for next year?
Well, you know, the Bs still look really good. You have really low vacancy rates in that B product across the country. One of the really good stories has been in some of these high supply markets where we've seen really, really strong demand, places like the Pacific Northwest, Bay Area, Denver, Texas. even the Carolinas and Nashville to some degree. Those Bs that are less competitive with the new supply coming in, they have just done absolutely phenomenally well. And so, we think that may taper off a little bit. You may start to hit some income thresholds in some of these spots, but they still should do pretty well. And I think that the bigger question is with the A's, again, with a lot of supply, does that start to catch up a little bit where all of a sudden, at this point, we've not seen the A's affected too much in terms of losing renters to these new units. But if that starts happening even a little bit, I think that we could see rent growth tick down a bit in the A's, and that may bring down overall performance a bit.
Okay, we're talking with Jay Parsons, Director of Analytics with MPF Research, a division of RealPage. And Jay, what about investment sales for 2014? It seems like it's been a really hot market.
You're absolutely right. I mean, apartments remain kind of the crown jewel in commercial real estate at this point. 2014 was the biggest year on record in terms of sales, 112 billion according to RCA. That was up 9% since 2013, and it's 7% above 2007. And that's a significant number because 2007 was the previous high on record. So we also saw big growth in apartment prices, and again, really, it's when you go back to pre-recession to where we are today, on both the rent side and also on the pricing side, that growth is certainly above anything that we've seen in other commercial real estate sectors.
And what are you seeing for cap rate trends?
Everyone thought they couldn't get any lower, and sure enough, they did in 2014. We now have cap rates under 6%, lowest in a decade, according to RCA. We see gardens are just north of 6%, while mid-rises and high-rises around 5%. And, of course, in some of these core markets, you're seeing cap rates in the 3s.
And what about cap rates moving forward, especially if we have a slight uptick in interest rates? We're having an increase in new supply, right? So what's the pro forma cap rates moving forward?
And Michael, I think that's the toughest question going ahead, just because, again, if you go back 12 months ago, was there a person in the industry who didn't think that interest rates were going up? And then, sure enough, they went down. And, there's some talk that maybe mid-year or in the fall the Fed may increase rates, but bear in mind there's very little pressure on the Fed to increase the interest rates right now. There's a lot of uncertainty in the rest of the world that's driven up demand for treasuries, and it's also driving demand for U.S. commercial real estate. So I think you can make the case that even if interest rates go up a little bit, cap rates may stay roughly where they are now, just because, first of all, the demand, and second of all, because the spreads on both the equity and the debt side are still really attractive, historically speaking.
What about the impact of new supply, especially for cap rates for these core Class A institutional quality properties?
Well, at this point, I think we would have seen an impact if that was going to be a factor. But I think what we're seeing is that the institutions are saying that, hey, we really want to be in these markets. And they've kind of grown those, from Sexy Six are now kind of expanding into places like Denver and Dallas, kind of that next tier. But I think what we're seeing is that they're, betting in the long-term demand tailwinds for these places. And what's really happening is not so much a shift in the cap rates, but in some cases a preference to say, hey, the acquisition numbers don't make sense anymore, so we're going to build instead. And that's how they're still getting in those markets.
Right. Yeah, I think we're going to see construction continue to ramp up, especially some of the cities that haven't seen a lot of construction yet. Well, Jay, what is in the numbers that might surprise people?
Well, Michael, that's a great question right now, because everyone's kind of, investors are always looking at, where are the inefficiencies in the market? Where's the next opportunity? And, in this phase of the cycle, this cycle overall, I should say, there's been just so much buzz about, the urban phenomenon. And it's a very real phenomenon. Please don't, get me wrong on that. I'm a big believer in it. But at this point, when you look at the overall fundamentals, the suburban story is I think has been downplayed to a good degree. We've done some studies looking at fundamentals going back throughout multiple cycles and throughout this current cycle. And when you look at good suburban areas, you see very similar performance in both occupancy and in rent growth numbers compared to those central business districts. And the key is really looking at good suburbs, those vibrant suburban areas that have lots of jobs and a lot of the amenities, the retail options, proximity to highways, higher incomes, higher home values, the kind of characteristics that you tend to see in the urban spots. And I think a lot of people make the mistake of treating all suburbs like they're the same thing. And if you think of whatever metro area you're from, you all know there's good suburbs and there's bad suburbs. And those good suburbs, I think, offer better opportunity at this point, particularly because cap rates tend to be about 50 basis points higher on average in those suburban places.
Yeah, that's a good point. It comes down to real estate's local, and you can see a community perform a lot better that's maybe a half mile away. Well, Jay, thanks for joining us today. We appreciate you being on the show.
My pleasure. Thank you, Michael.
Well, stay tuned. We'll have more on the multifamily market. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's REALNEX. FIU, Florida International University. Earn your master's in real estate in as little as 10 months without interrupting your career. Visit FIUonline.com. Xceligent, the resource professionals use for commercial real estate information. Visit xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit CREshow.com.